Over time, the stock market has shown to be a terrific means for regular people to accumulate wealth. Get-rich-quick scams typically benefit the person on the other side of the wager if they are successful. However, investing in excellent businesses at fair pricing might be a terrific way to get wealthy over time. For some people who don't have the time or desire to continue investing, it might be as easy as using index funds. Finding excellent investments and companies, though, can help increase returns even more. These 10 stocks could provide a diversified means of outperforming the S&P 500 index in the ensuing years and decades. To put it simply, 2022 was a year distinguished by rising costs, astronomical interest rates, and concerns of a possible recession. As commodities rose and the sudden commencement of the Russia-Ukraine war disturbed global energy markets, growth and IT businesses were crushed, and the S&P 500 lost 18.3% through December 15th. The energy sector emerged as the largest winner. However, given the rapid phasing out of brands that are more growth-oriented, chances will still exist through 2023. Thanks to the sale of a number of high-quality names, investors now have the chance to buy shares in well-established companies at a discount just because of some short-term anxieties. Even though most investors are emotionally driven, buying stocks during a slump has historically been a smart strategy. Here are the top 10 stocks to invest in 2023. 10. Diageo plc. Diageo, a consumer defensive company, should be able to endure a difficult macroeconomic environment because alcohol is typically generally recession-resistant. Similar to smokers, drinkers usually have great brand loyalty, and the company holds an enviable position in the market thanks to its portfolio of premium brands, which includes Johnnie Walker, Guinness, Tanqueray, Don Julio, Smirnoff, Baileys, Ciroc, and Bull Light. The stock has recently underperformed, dropping 17.1% from 2022 through December 15th, despite a fiscal year 2022 net sales gain of 21.4%. Its UK roots and the weak British pound are the main causes of this. Shares currently trade for 18 times fiscal 2024 projections, a decrease from its 5-year average of 24.5, and that downturn can't last long. 9. Taiwan Semiconductor Manufacturing Company. Limited Taiwan Semiconductor Manufacturing, a $400 billion firm and the top high-level foundry with more than 90% of the market share for advanced chips, comes in second on the list. TSM dominates the market for chips with a diameter of 7 nanometers or smaller in the semiconductor industry, where foundries are companies that manufacture chips for other companies. Apple, which has started to shift its supply chain away from China, is one of TSM's biggest clients. In response to federal incentives for local chip manufacturing, TSM recently decided to build a second plant in Arizona, bringing its total investments in U.S. manufacturing to $40 billion. TSM is another Buffett asset, trading at barely 13 times forward profits and yielding a 2.2% dividend. As of the company's third-quarter disclosure, Berkshire owned a $4.1 billion interest in the company. 8. Grupo Aeroportuario del Sureste S.A.B. de CV. A $7 billion Latin American airport operator is this off-the-beaten-path investment, which is another selection from the previous year's list. The single industrial company on our list, ASR, offers geographic diversification, is a mid-cap company that few investors are familiar with, and is a company that few investors are familiar with. Through December 15th, the stock had generated a cumulative return of 19.8%, making it a hidden treasure in 2022. Of course, it also helped that passenger traffic returned to normal this year with a vengeance. In the third quarter, it increased by 24.5% year over year, which was an increase of 22.8% from the third quarter of 2019 before the pandemic. Airport managers make money from a variety of sources, including parking, ground transportation, airport retail, advertising, and the leasing of gates and payment of landing fees by airlines. ASR's largest airports are in Cancun, Mexico, San Juan, Puerto Rico, and Medellin, Colombia. The stock pays a 3.1% dividend. 7. EOG Resources Inc. A repurchase contender from the best stocks to buy list from the previous year is the American oil and gas firm EOG. It just experienced a fantastic 2022, during which time the stock's total return, including dividends, reached 53.4% through December 15th. The shares are still valued like bargain stocks because they trade for less than 10 times earnings and around 8 times expected earnings. Since the hot energy market is unlikely to skyrocket like it did in 2022, which was plagued by inflation and war, growth will surely slow down in 2023, but investors shouldn't undervalue the significance of having an inflation hedge in their portfolios. EOG has considerable credibility with income investors thanks to its 2.6% dividend yield and remarkably low payout ratio of around 24%. 6. PayPal Holdings Incorporated. PayPal, a dependable financial company, is bizarrely trading for less than its pre-pandemic levels despite projected 2022 earnings per share of $4.08, higher than any year between 2018 and 2020. Shares suffered substantial losses in 2022, plunging 63% until December 15th as a result of a deteriorating macroeconomic environment and the end of its incredibly lucrative alliance with eBay Incorporated, EBAY. Despite a price-to-earnings ratio of 38 on average over the past 5 years, shares are currently trading for barely 15 times projected earnings for 2023. By using projected 2023 earnings of $4.73 and PayPal's lowest P/E ratio between 2015 and 2021, one may calculate a price of almost $96 per share by early 2024, indicating a rise of more than 37% in less than a year. Its footprint in physical stores may increase as a result of recently announced agreements with Apple Pay to accept PayPal and Venmo-branded cards. Amazon now takes Venmo, providing PayPal access to its enormous online marketplace. 5. Walt Disney Company. When selecting stocks to buy and hold for the long term, one of the most important considerations is the management team of the company. And Disney has that in spades thanks to the longtime CEO Bob Iger's recent comeback. Iger, who is recognized as one of the strongest CEOs since the turn of the millennium, presided over a series of tremendously profitable acquisitions, including Pixar, Marvel Entertainment, and Lucasfilm, before turning over the reins to Bob Chapek in February 2020. The COVID-19 and increasing inflation were only two of the challenges Chapek had to deal with, but he also struggled to inspire Disney employees, became embroiled in divisive social topics, and arguably overspent on content for the Disney Plus streaming service. Nobody is more suited than Iger to lead a turnaround at the House of Mouse, given that Disney shares have fallen more than 30% in the almost 3 years since Chapek initially assumed the helm. 4. Amazon.com Incorporated. The market leader in online shopping, Amazon, also seems like an enticing investment going into the new year, with shares trading at almost a 50% discount from where they did a year ago. The stock had a sharp decrease as a result of cost inflation, a tight labor market, problems with the supply chain, and waning consumer confidence. The market, however, has been far too quick to write off Amazon, whose crown jewel is its big, quickly growing, and highly successful cloud services segment, Amazon Web Services. The expected yearly revenue of AWS is $84 billion, and it is rising. Microsoft Corporation should receive approximately 10 times more money from AWS. MSFT, a competitor in the cloud services market, given that MSFT trades for about 9 times sales. Investors are getting the remainder of Amazon's enormous operations, including its retail business, Amazon Prime, digital advertising, and other businesses, for just $60 billion if AWS is worth $840 billion at Amazon's current $900 billion valuation. 3. Citigroup Inc. The next international bank on the list is Citigroup, which has departments for retail and investment banking and has assets of $86 billion. Citigroup will provide 2 advantages to investors in 2023. First off, its 4.4% dividend yield gives shareholders a respectable cushion in times of rising rates and strong inflation. Importantly, Citigroup ensures that its dividend payments will be steady over time by financing them with less than 30% of earnings. Citigroup appears to be a good investment because it pays a sizable dividend and is now trading for less than 7 times forward profits and just 0.5 times book value. Warren Buffett, a well-known investor and financial expert, started purchasing Citigroup stock in the first quarter of 2022. At the conclusion of the third quarter, Berkshire Hathaway Incorporated owned a nearly $2.3 billion holding in the corporation. 2. Dutch Brothers Incorporated. While well-known, major companies like Apple may offer some stability to investors, smaller companies have more room for expansion and can help investors build stronger portfolios. Enter Dutch Brothers, a rapidly expanding coffee company that is worth more over $5 billion despite being only about 0.25% the size of Apple. In the third quarter, revenue rose 53% year over year, growing like a plant. Dutch Brothers, a company with West Coast roots, today has 641 locations across 14 states, the most of which are in the West and Southwest. Due to its small footprint, its drive-through facilities are relatively affordable to open, allowing for rapid expansion. According to the data, through the third quarter, Dutch Brothers added 103 more stores to its site count, growing at a rate that was 19.1% faster than that of industry leader Starbucks Corp's 2.8% location growth, SBUX. 1. Apple Inc. Apple is the biggest publicly traded company in the world if you exclude giants funded by the government like Saudi Aramco, the world's largest oil company. Similar to other IT companies, AAPL shares experienced a challenging year in 2022 due to recession concerns and rapidly rising interest rates, which frightened investors in the sector. After a remarkable 23% slump, Apple is currently trading at 22 times profits, giving investors a solid entry opportunity into the $2.2 trillion iPhone maker. Apple's extremely stable business environment encourages customers to keep using its goods and enables them to upgrade to more advanced versions year after year, providing some predictability to its income and security to its stock. Even if its 0.7% yield is nothing to get excited about, the company is committed to giving its large cash flows back to shareholders in the form of a steadily increasing dividend and share buybacks. In its most recent fiscal year alone, AAPL spent around $90 billion on stock buybacks. If you like this video, like, comment, share, and subscribe please, as this helps grow the channel.